And thanks to Voya also. When you give a bond manager a microphone, you don't know really what you're going to get. Thanks also to Robert and Brittain to join us today, and we hope that we present a viewpoint of where we are in private wealth management and where we're going. Robert and Brittain both have been introduced. Let me start off with Robert, just because Balentine today is very different than Balentine 25 years ago. With that, Robert, if you could benchmark where the company is today, where you started, the road traveled, if you wish, as far as your career, I think that would be instructive for our group.
I'm going to stand up because I think the podium is blocking those of you on the other side. I want to start by saying it's a real honor for us to be here today, and I appreciate Joe inviting us to speak. When I got out of college in 1979, there were two tracks in investment management. One was either sales and the other was managing money. And I'll remind those of you that weren't even born then that the 10-year bond was yielding 15%, and you could buy America's best companies at single-digit PEs and double-digit practically dividend yields. So it was a lot different back then. And when my dad and I left Merrill, he'd been on the capital markets group for 20 years. I had been there for 7 years. And we thought, frankly, getting paid commissions was a conflict of interest for investment advice. So we set up an RIA. We also thought we could do a better job allocating assets and picking stocks. And so the idea behind open architecture asset allocation was typically not what we saw in the mid-1980s. So right after we started the firm, and when you start a business, you never know what's going to happen. My dad was diagnosed with prostate cancer 2 months after we started, and then in October of '87, I watched my Quotron, which I didn't even think could go into double digits, go into triple digits, and the market dropped 30% in 2 days. Things have changed a lot, and we sold that business to a public company. We spent 7 years wandering in the wilderness, started over again with 12 people in December of 2009 with the idea of being able to build the kind of firm we'd hire to manage our own capital. So today we have 2 offices. We're headquartered in Atlanta, a couple of doors down at 3344 Peachtree. We have an office in Raleigh. We have about 40 folks, and our business is primarily wealth management. Our average client is about $18 million. We have a couple of hundred clients. But 3 years ago, we went through the pain, and I underscore the word pain, of becoming GIPS compliant, and decided to start marketing our global asset allocation strategies institutionally. So that's kind of the business today, is a high net worth business serving primarily business owners and global asset allocation strategies for institutions.
On that note, Robert, where do you see the expected growth of the firm going forward as far as either types of clients or broadening the base of entrepreneurs that you serve?
Well, 5 years ago, our partner group made a decision to focus, because when you start with a small group and you add staff and you have a lot of rent and overhead and you have no clients, that tends to get your attention. So it was kind of a land grab for revenue in the early years, whether a client was an endowment or a foundation or an institution, inherited wealth, business owner, professional. If they met our $5 million minimum and had a heartbeat, we wanted to work with them. And a few years into it, we realized, the best firms in our industry focus. And so we decided to focus on business owners, because as entrepreneurs who built and sold an operating company, we basically cobbled together an operating company within a public company from component parts and started over again. We understood the psychology of the transition event, how managing your money is different than managing your business. And the other thing about business owners is they don't have that annoying habit typically of spending out of the portfolios like endowments and foundations and retirees do. They didn't add to the portfolio. Plus you had a call option on managing the money once there was an exit. So we focused on business owners. We imagine that's going to continue to be our focus, but we also see an opportunity to move up market, serving as a multifamily office for these clients, At the same time, the investment process that we manufacture for our core wealth business, we see can be distributed through consultants to institutions that are typically seeking to allocate maybe 10% of their portfolio towards a tactical global asset allocation strategy.
Very good. For a moment, Robert, why don't you take your view as to the direction of the industry, where we are right now, where we've come from, and where you think that we're moving?
Joe, I think first of all, the wealth space is a great space. The number of broker-dealer registrations are slowing. The number of withdrawals are increasing. People are moving away from a suitability standard of care to a fiduciary standard of care. I think we're going to continue to see the independent RIA channel accumulate more assets under management. I also think there's likely to be a tendency to move away from pricing as BIPs on AUM towards engagement letter pricing. When you're in the wealth business, managing money might be one of a dozen things you do. You might be helping the client with legacy planning, philanthropic planning, governance issues, tax, estate, financial planning. But typically the way we get paid is managing money. And so for some clients, if you own an operating company, it may not be a good idea to sell the operating company. Maybe you ought to take in additional capital and grow that business. But if you're in the money management business, you're conflicted from giving the client the advice that's not going to create liquidity. So in our firm, we've been moving more towards engagement letter pricing, where we're looking at fixed fees that might have a combination of an asset management fee and an advice fee. And I don't think the business of advice is going away. I think investment management is perhaps increasingly considered becoming commoditized, but the advice business is not. So I see our industry pivoting maybe away from simply fees on assets under management to more engagement letter pricing. I also think when you consider that 27% of RIAs are north of $1 billion, so nearly 3/4 are below $1 billion, there'll be increased consolidation. We'll probably end up with a number of national players and then maybe some super regional firms. But the tendency of breakaway brokerage firms is continuing to increase, where teams are leaving warehouses and setting up independent firms, but they are faced with compliance burdens and how to scale their business. So I think that consolidation will likely continue.
Robert, if you could, describe the process and perspective used by Balentine in managing client portfolios. In other words, a client comes in, how you deploy assets based on their investment policy and
well, the first thing we want to do is a diagnostic and create a financial plan. I think it was Lewis Carroll's Cheshire Cat who said, if you don't know where you're going, any road will take you there. So we believe very much in goals-based investing. We want to be sure that we understand working as a collaborative team with the client's other advisors, their tax, their legal advisors, their insurance advisors, working together on behalf of that client, helping them understand where they are going. And then once we understand the strategy, fundamentally we believe investment management is more about managing risks than return, and the way that we mitigate risk is through broad diversification. We tend to favor low-cost, passive solutions in public markets. I think it's very difficult for a lot of people who went to great schools to ferret out some nugget of information that's going to give them predictive insight as to whether this company's earnings are going to be better than another company's earnings for the next quarter. And let's focus on the things we can control, which are the fees we pay for implementation and the volatility we're willing to accept.
We want this to be interactive, and at this moment, let me just turn it to the audience and see if you have a question or questions to either Robert or Brittain. Let me turn the, oh, excuse me, Andres.
What's the biggest threat to your business? You're one of the bigger independent advisory firms here in Atlanta, in the Southeast, and in the country. You're consistently named as one of the most successful wealth management firms. But what are the threats that your management team takes about 3, 5, 10 years out? We just saw a presentation on robo technology.
Well, for those of you that didn't hear, the question is, what do we see threats in our industry? The one truism in business is typically the competitor that takes you out is not the one you see coming. I also remember my dad telling me, remember in the back of my mind the Caesars walking, or the people walking behind the Caesars in the streets. This is maybe an apt analogy for Holy Week. Whispering in their ear constantly, fame is fleeting. So always, as Andy Grove said, being paranoid and thinking about what can go wrong. But I think this is a wonderfully collaborative industry. I think we're seeing more and more people that kind of want to move into it. But if you do the right thing for your client and you try to put yourself at the back of the line, I think the good guys win in the end. There are lots of people that want to get in this space. Accounting firms are in this space. Even law firms are in this space. Certainly insurance companies. Everybody wants a slice of this intergenerational wealth that we've all read about for years. I think the challenge is, how do you deliver in a client-centric environment a better experience that's going to cause people to refer business to you?
And aside from the comment that was, or the question that was asked, Robert, take the audience through the period where Balentine became Wilmington Trust and what the challenges were in operating what became a big company.
That was a dark period. And I see some of my former Wilmington Trust colleagues in the office, and I'm going to let Brittain chime in here too, but the main lesson I learned is you can't change the culture unless you're the leader. We naively thought, as an entrepreneurially driven group of 50 people, being put inside this publicly traded company, everybody always trusted banks, but they didn't think banks were particularly good at managing money. They thought Wall Street was good at managing money, but they weren't particularly trustworthy. So, my brainchild was, you put a really crackerjack investment team inside of this bank and it's going to be great. And it was great in the first couple of years. I mean, they were sending us $150 million a month of new money. I don't know that it was because we were that good more than that they were that bad. But it became apparent that unless you are the leader, as I said earlier, you can't change the culture. And culture is so important in our industry. We are an industry where all the assets go down the elevator every day at 5 o'clock. And our people are our competitive advantage. And if you can't keep the culture together and incentivize people in a common way to help them succeed, you're going to end up with silos and divisiveness. Pay determines behavior. And I think that's where the brokerage firms have gotten it wrong. And that's why there's so much competition even within the brokerage firm. We try to work as a team, and unfortunately, the way that the company that we worked with earlier was not really set up as a team structure with a team reward. It was all very silo-driven.
Let me take this question to Brittain.
I'm going to let you stand up.
Benchmark the differing needs across your client types, and this could be an entrepreneur, this could be inherited wealth, this could be an OCIO opportunity that's maybe an institutional client, but what are the variety of needs across your client types?
First, I think you make a mistake if you try to benchmark clients. I think that we spend a lot of time trying to segment and trying to figure out what process for what size and who needs what. And I think ultimately what you have to decide is, what are you good at? What are you good at? And then you ultimately get the right kind of clients, if you're able to explain that. As Robert was talking about, I think we've evolved from, I joined in 1994, he started in 1987. We were really more of an investment advisory firm. And now we are truly a wealth management firm. And the way that we have evolved is by learning. And your question of what is the risk, it's not evolving. It's not evolving with the client base. It's not evolving with technology. And I think one thing Robert has always been great at is looking forward and saying, what are we missing? And I think the same thing goes with clients. We do focus on the entrepreneur. I think what we figured out is we are really, really good at understanding the needs of an entrepreneur. I think we actually enjoy that. If you look at the wealth management pie, investments are a slice. They're an important slice, but they're a slice. Hate to say that to CFA designation holders, I know we love to focus on it, but it's a slice. There are other slices of the wealth management pie that I think people have got to focus on, and that's what I think if you benchmark our clients, they want us to answer the questions that they are not asking. They want us to understand what their problems are going to be before they realize what they are. And I think that's what's so fun about, especially the entrepreneur in transition. And you're getting younger and younger people selling companies for 30, 40, 50 million dollars. And their biggest issue is, how do I make my kids not be jerks? How do I educate? How do I convey my philosophy of wealth? What is my philosophy of wealth? You know, so that's where I think that clients need us to be, and that's where I think we really are focused right now.
Keep standing.
Standing.
Let's talk a little bit about investment trends in private wealth management, in other words, the industry. ESG investing. Is it a development trend in private wealth management? Do you think it might be more important to millennials and Gen Xers than your current client base? And are clients even aware of it? Do they come in and say, can you put together an ESG-focused portfolio?
You know, it's interesting, as I think about this question, how many people remember going to the grocery store without thinking about taking 6 bags in your purse to make sure you don't have to take the plastic? It seemed that truly overnight, I was appalled and would go back home to get my bags so that I wouldn't have to get plastic bags. I think that happened really, really quickly. Right now, ESG is not something a lot of our clients are focused on. Our endowments and foundation clients are a little bit more focused in that area. I think corporate governance, part of the ESG, is something that everybody is really taking notice of. I do feel like we are doing some research on that. We do have solutions in the private capital area more than in the public markets, but I do think it's coming, and I think it's coming quickly. I think even more important, and something that's close to my heart, is impact investing, which I think is going to be, I do think the millennials as a group, by the way, I love millennials just in general. I think I am a millennial in an old person's body, but I think they are issues like that and impact investing, but understanding impact investing is not just about making a return. It really is. It's kind of philanthropy and return together, but you have to have that philanthropic intent. So, long way of saying I think it's coming. We've got to be prepared.
Do you think that it's going to be easier to quantify what is ESG as we move forward?
Yeah, I think there are very specific attributes, and I think the UN has defined 17 that a company has to follow. But I think that's probably going to get sharper. I think it's going to be harder. The space right now is not as well defined. What you want to do is, if you are looking at performance, you want to have the data set be consistent.
Gotcha. Let me put this question to Robert. In the industry, is the trend toward ETF usage good or bad? Does a client view ETF usage as a cookie cutter approach to portfolio management? In other words, you line up 5 advisors and they all have 5 different ETF portfolios. But with that, there are 2 questions. So,
we have a philosophy that passive investing requires active due diligence because there are lots of flavors of ETFs. And what we are seeking is exposure to an asset class that is liquid and that is efficient and that is low cost. If I can save 50 basis points a year on implementation of investment advice on $1 million at a 7% rate of return over 20 years, that's $350,000. So fees do matter over a long period of time. And I gave a talk a couple of weeks ago with the most up-to-date Dalbar slide that most of you have probably seen. The evidence is just not getting any better about the persistency of active management. Everybody is saying, well, let's wait until the next leg of the cycle. We're in the longest era of economic expansion, and we will be as of this summer since 1865. Active management is going to shine. But ever since the SEC passed the Fair Disclosure Rule in 1998, with the widespread availability of information on the internet, 24/7, it's just very, very hard for analysts who are picking stocks to do better than what we could do with an index. Now, we happen to believe that there's significant alpha to be achieved by tactically shifting into different indices to employ asset allocation. But I'd rather get the house or the neighborhood right than worry about the house. And I do think, there's concern about counterparty risk and liquidity and all kinds of other things, which is why you have to do your homework. But I think it's a trend that's here to stay, and I would not want to be making my living picking stocks.
Very good. Let me ask this question to Brittain. Private wealth as an industry and firms generally. Are firms ready for millennials and Gen Xers as clients? Have you all seen a trend in wealth management to these groups as far as either wealth transfer or if they're lucky enough to make it on their own?
Well, I'd say we better be ready, both on the employee side and the client side, because they're here and they're working hard and they're doing well. I do think that if you looked at the difference in our client base, maybe not quite millennials yet, but we're seeing a lot of people that are young and making money and having a transition of wealth where they need help. We are not as focused on, since we do have what Robert's talking about, the $18, $20 million average size clients, we don't have a lot of them, but right now we have a 30-year-old young person who has made about $20 million right now and is probably worth about 100. And he doesn't have a house, doesn't have a car, barely has a bank account. Those people need help in a very different way than the sophisticated investor who's 65 years old and is looking for investment advice.
Interesting.
So I'll also add that if you don't have younger advisors working with clients' children and engaging them, those assets are going to leave when mom and dad aren't there anymore.
Speak a moment to that, because I think that's important as far as running a firm or the business of investing is not just being the captain of assets for mom and dad, but being the captain of assets for the family. In other words, it could be 4 or 5 children or whatever it might be. What's holistically your all's approach as far as that?
We think it's hugely important to engage the family. I find, as I was saying, certain things are important to people a lot more than just investments. One of them is education of children. And education of children means different things to different families, but engaging these young 20s, young 30s is imperatively important. We have an event that we're going to be doing in September called Children and Money, and I think it's the most, it will be well attended. People are excited about it. They want to, understand what are other people doing, what are other people telling their children, how are they educating their children. And a lot of times, as Robert says, if I have an advisor who's 32 years old, they might have a better connection to that young person and be able to communicate differently than maybe some of the rest of us are. So that it's the whole family unit.
A selfish question as far as children and money, is that specific to Balentine clients or is that broader outreach?
Stay tuned. Stay tuned.
Okay.
Right now, it's for Balentine clients.
Okay, very good. Brittain, again, as far as business trends as it relates to private wealth management, and I call this the business of advice. We're all charging a fee and advising clients, and I think looking at it as a business is very important. An asset-based fee model has really been historically what the industry has fallen into. Do you all charge a fee for services outside of strictly asset management? In other words, if there might be some private assets or illiquid assets that are involved, how do you kind of look at the client and what you're providing the client and getting compensated fairly for that?
Historically, we have had largely an AUM fee, assets under management, assets under advisement, whether we're reporting on outside assets, whatever we're doing consulting on businesses. And as Robert alluded to earlier, we are very focused on moving more toward an engagement letter fee. And one thing that does is it allows us to have a client that might not necessarily meet our minimum, but they are willing to pay a fee in order to get our team for services they need before they get liquid. I mean, we have a situation with someone who was worth probably $300 million, had less than $200,000 invested. And we have spent lots and lots and lots of hours on estate planning, on accounting, on education of children, on consulting with the business, understanding and helping with a potential sale. So, long answer again, engagement letter pricing, I think, is the way that the business is going, and I think it is a more appropriate way for us to charge our clients for all that we're doing.
How do clients take that from a perspective of seeing value in, okay, we're managing money and here are all the other things that we're doing? Is it easy to make that value?
It is incredibly easy, and I would encourage everybody, because I had a client just last week who said, you know, I've got grandchildren's trusts that are kind of small and you're not really doing that much. Should we be charging on that? And so I went back and said, let's talk about what we do. Let's talk about a relationship management timeline. Let's talk about all that we do for your family, and then we'll talk about the fee, and then we'll talk about whether it's worth it. But we, as an industry, ask clients to look at the wrong thing, I think, sometimes, because we are doing so much more and we don't tell people. So I think once clients have that conversation, I think they feel a lot more comfortable understanding, let's lay out exactly what we're going to do for you, which does include asset management, and it's been very well received.
One more question, Brittain. Following clients into the stage of retirement, or what some people call decumulation, which is actually a word. What are some of the strategies and advice provided as a client enters that phase of their portfolio? And at what point do you have the conversations as far as retirement or retirement spending or going into that phase of their lifestyle?
People have often heard me say that I see retirement or a sale of a business sometimes more difficult for people than death. And that, I'm not being funny, it truly is a very difficult time for people. So I talk less about assets, though assets are important because you start taking from a portfolio as opposed to building, and psychologically that's very, very difficult. But I think if we can prepare the CEO who's selling a business, if we can prepare the doctor who is retiring for some of the things that are going to come, as simple as you hadn't had to buy a plane ticket for yourself or schedule a reservation at a restaurant. If you don't want to do that, let's make sure we prepare you for that. What are you going to do? What are your philanthropic what's your philanthropic intent? How can we help you prepare for this next stage in life? And then you start talking about the money and how you're going to feel comfortable spending as opposed to accumulating. And that's just hard for anybody, especially a spouse.
Let me ask this question to Robert on the same theme of decumulation. A lot of people have thrown out a 4% target as far as a spending policy, if you'd like to call it that. Not that we're an endowment or a foundation, but it's a private portfolio. Is that realistic? Is a spending range more realistic? In other words, it's not a set number, but it's a range based on investment experience and need?
I think that's a realistic range. It's a lot easier conversation talking about a 4% spend than an actuarial assumption that requires a defined benefit plan to earn 8. Because if you assume a traditional 60-40 blend, and that the greatest predictor of future returns in fixed income is the starting yield in the 10-year, and so let's make the math easy, call it 2.5. If I've got 40% of my money earning 2.5, that's a point. If I'm going to spend 4, and let's say I throw another point in there for fees, which means I got to earn 5, and I want to keep up with inflation, and that means I've got to earn 7. If I assume inflation's at 7%, that means 60% of my money has to earn 6%, which means my stock portfolio's got to earn 10 if I'm gonna spend 4 in a traditional 60-40 mix. That's a pretty tall order. But what we've tried to do is to help model cash flows in retirement for clients and ensure they have a margin of safety by keeping at least 2 years' worth of spending net of portfolio yield liquid, so that they're not having to touch risk assets during a period where they may be impaired. So if the client is spending $500,000 a year from their portfolio and they've got a $10 million portfolio throwing off 2.5%, I've got to keep another $500,000, which is 2 years' worth of spending net of portfolio yield liquid. I think if I've got my liquidity immunized and I've got access to assets and I've done my planning and I've modeled it out, I think 4% is a reasonable rate of return if I am able to generate some alpha through tactical allocation, if I'm able to include other asset classes besides stocks and bonds like private capital, then I would feel good about that. I do not feel good about our public plans that are having to chin an 8% bar.
Agreed. Let me ask the audience if there are questions.
What is a good, a lot of us are in the brokerage business, and we don't know what the financials look like on the RIA side. What does a good income statement and balance sheet look like for a good RIA?
The question is, what's a good balance sheet for an RIA?
An income statement, you know, what metrics would you look at to say, this is, how would you measure a successful RIA? What metrics are you shooting for?
A lot of assets and few liabilities.
Profit margin.
And the more EBITDA, the better. I would say, I think a well-run RIA ought to be able to drive 30% plus margins. I think when you get up north of 40, you're probably not reinvesting enough back into the business. When you're looking at valuations, you typically look at not just the absolute multiple on the EBITDA, but the trend, underlying trend growth rate, and how that EBITDA is able to grow. You look at things like client concentration, mix of business. I think the wealth business is going to have a higher multiple than the institutional business. What is the persistency of assets? What's been the turnover among clients? What's been the turnover among the internal team? How broadly is the ownership spread? Is most of the equity in the hands of an aging founder where you know the firm is likely to have a liquidity event? If I'm acquiring an asset management firm, I want to build a moat around all the things that can go wrong, and that to me is regular recurring fee income, running your business as it's always for sale. In fact, my colleague Adrian and I are writing a book that should be out in September called First Generation Wealth, and one of our chapters is always run your business as if it is for sale. That's going to give you the most options, and it's also the best way to go about running the company. Is that helpful?
There's a question.
Is there another question?
Could you tell me how you go about creating the level of engagement team? I mean, what goes into it? And
Well, that is something that evolves. I think it really depends on understanding clearly what does the client want. We start with some basics that we know we want to provide and we will have the client pay for, but ultimately is determined by what do you need. Are you 5 years from the sale of your company and you want advice in terms of monthly cash flows and all that? Or is it imminent? Do you want us to come in and be more involved in those decisions? So it really is, it's more difficult because it needs to be specific to each of the clients.
is much of it recurring, or how much of it is recurring versus transactional?
Recurring advice, the same type.
Yeah, like a base engagement fee?
Yeah, it's probably, I'd say 60%.
Was there another question?
Can you elaborate on getting to get some clients?
Don't do
Don't
it.
do it. No. You go.
No, I I heard the other day from our chief compliance officer that only 3% of wealth management firms are GIPS compliant. And I now know why, because it's really a pain. But I mean, there are firms that shepherd you through the process. It's really all about getting your composites together and being sure that you've got the right clients and the right composites. It's a lot about disclosure. So even when you meet with a prospective client, once you have decided on a strategy, you're required to give them the GIPS verified track record. But what it allows us to do, and we found it's a real competitive advantage, is it allows people that are hiring investment management firms to compare apples. Because we've joked internally there must be 4 times as many managers out there as there really are, because everyone we've met's always on the top quartile. You know, they pick the beginning date, they say we are #1 small cap manager from Halloween of 2013 through Thanksgiving of 2016, and they run an ad about it. So what GIPS allows you to do is kind of level the playing field. And I tell people that are thinking about hiring investment managers, pay attention to 2 things. One is the stability of the investment team, and second is the client turnover. Because if you've got a very low client turnover and you've got a stable team, the chances are pretty good, despite what the SEC says, that past performance is going to be a pretty good indication of future results.
Stand on up again, Robert. Let's talk about practice management and private wealth management. Business or practice valuation. Should organizations, on a recurring basis, maybe it's annually or every 2 years, determine the value of their business? Is it the type of thing that, not an ego trip, but a way to say, as you did earlier, that you're always for sale, and to at least understand the value of what your business is, and for the employees to know that also? Just some thoughts on that.
Well, I think as any business leader understands the value of measuring what matters. We run trailing 12-month charts on all of our KPIs to spot trends. We buy and sell equity at a predetermined multiple of EBITDA internally so that that equity is able to be recycled. We have a very kind of egalitarian approach to ownership. We want everybody to think like owners. So in our firm, if we win a big piece of business, no one person is going to get a commission or a pop in their paycheck. We work as a team. So if you're not a partner in the firm, you're a participant in the profit sharing plan. The profit sharing plan is set each year with certain bands based upon a target and kind of a worst case and a best case, so that when we win that large new relationship, everybody's happy. You know, the person at the brokerage firm that wins it is thrilled, and their assistant's there until 8 o'clock at night trying to get the paperwork. I mean, it goes back to what I said earlier about pay determining behavior. But with our partner group, if we see that somebody is living our 4 core values, and they are additive to the enterprise, and they are always improving, and they're moving up the trajectory, and we decide to offer them partnership in the firm, they're given an opportunity to buy into the firm, and we have a mechanism to buy that equity, or to sell them equity, finance that equity, because our philosophy is we don't want somebody's inability to be able to write a check to preclude them from being an owner in the enterprise. But I think every business runs according to the way it's designed, and if your business is running well, it's designed well, and if it's not, you ought to be looking at tinkering with the design and figuring out how you can make it better. So I think, yes, annually, it's not an ego trip, it's a metric of how we're doing as a firm. And if you're not always seeking to grow, you're going to die. It's like any organization.
Keep standing. Another question. Succession planning. Has Balentine formally prepared for the future? The industry appears to take a do as I say, not as I do approach to succession planning for firms. Where does that create risks, and should succession planning be a priority as far as?
I think succession planning absolutely needs to be a priority. And it doesn't matter just because of the tenure of the founding team, the age, you never know what's going to happen. I'm thinking of a firm, a very successful mid-cap, large-cap value equity shop in New York, where a 42-year-old CEO got a brain tumor and was dead in a year. So you've always got to be planning for contingency. Our industry has more advisors over age 70 than under age 30. And so there's going to be a lot of transition over the next several years. Our firm went through a formal process about 18 months ago where I named Brittain president, I named Adrian CEO, not because I planned on going anywhere, and I guess our partner group at the time, we had 7 partners at the time, but because I think it's important to be able to let the next generation come in if you're going to have continuity in the business. And the clients want to understand that. The clients want to understand what is the stability of the ownership of the management team. Because I hate to say this, because we sold our company to a bank. Everybody that I know that is exited, within a couple of years, all the people leave. It never, no matter how great you think it's going to be, when there is an acquisition, people leave, clients leave, it's not the same. And so having a formalized succession plan in place, shows clients that there is a plan, that there is life after Robert or whoever, a founder happens to be, but it also sends a message internally to your team that this is a company that's built to last, and to the clients.
Great. Let me shift this question to Brittain and just a few moments to talk about client service. And is there a formalized model that Balentine uses as a client service objective, or anything that's formalized, or is it really tailored to each client as far as how they are taken care of?
Well, as I stated earlier, you do really have to customize each relationship, but ultimately, it took me about 28 years to figure this out, so I did it last year, that institutionalizing the client service process. What is it that we do for clients so that we can communicate both internally and externally, and it goes back to, what are you doing for me? If you do that. So we went through a process by which we segmented clients by what do they need, and then what process are we going to go through to serve this client. And what it ultimately does is it makes you be proactive instead of reactive. If you understand that these 25 clients are going to receive estimated gains, losses every quarter, instead of reacting, everybody's scrambling, that's done. Documentation, understanding that if Brittain gets hit by a bus, we need to understand what's in her head. And so the documentation of how we handle clients. What is it? Why did we implement the strategy that we implemented? How many entities are involved, and why do we have them allocated the way we do? How do people like to be communicated with? So I think it's imperative to have a very specific way to institutionalize client service and make sure that everybody's getting what they deserve, and also that you can communicate it.
Keep standing. I've got another question for you related to practice management. Cybersecurity. The industry and the SEC has placed emphasis on investment advisory firms to adopt and maintain cybersecurity procedures and initiatives. Generally, what has Balentine done to protect itself and its clients?
Well, we've tried to be ahead of the game. We have an outsourced technology service which is constantly focused on cybersecurity. Our custodian Prigge has spent a lot of money, but it is a huge, back to your question, huge risk. How many people in this room have had an experience with wire fraud? We all think we have a process in place to make sure that doesn't happen. And it's astounding how many people get what do we call them? I guess the criminals, the cybersecurity. They are getting smarter. They're smart. And if we don't have a process, we're going to get caught. And I think clients are more aware of this. I think you have to engage all the employees. I think compliance is a huge issue. And I think that clients are worried, and that's one of the first questions they'll ask.
Let's turn over to the discussion of human capital, Brittain.
Okay.
When searching for new employees, what are some of the critical capabilities, habits, and skills that are valued at Balentine?
Well, we only like millennials. I'm just kidding. We are, as Robert alluded to our culture, and it's interesting how many people come in and say, culture's important to me. And I say, what do you mean? Well, culture, right? And so we start saying, what is culture? You know what culture is? Culture is what people talk about, your employees at the backyard barbecue, what they say about their firm. And so I think we got to be real aware of what our culture actually is. We can talk about, I remember probably in 2012, somebody walked up to me and said, we have all these values, you know, and one of them is work-life balance. And you email at 2 and 3 in the morning, you miss all of your children's stuff. So we don't really buy into what you're preaching. And so we totally redid everything and said, what is our culture? Well, work-life balance at Balentine, sorry, it's probably not the highest priority for everybody. So if 9 to 5 having your desk need at the end of the day, probably not gonna be a great fit. So one of the first things we say when people come in is, here's who we are. You know, mutual respect is hugely important to us. Excellence is hugely important to us. Integrity is hugely important to us. Entrepreneurial spirit, you need to probably not be bureaucratic. So it's really important for us to have a keep it real conversation from minute one when people come in to interview. You will find there's some people over there that had to go through the interview process at Balentine, and it could end up being comical because it is so onerous. But we have learned that making a mistake with employees and culture has a far higher cost than anybody might imagine.
A couple more questions. As far as recruiting talent, is it equally challenging to source operations professionals and portfolio managers? How do you recruit new talent?
It's an interesting question. I think everything that we've done, it's because we've screwed something up and we've realized it and we've tried to get better. So understanding, being able to define a role. You know, if you look, and as you know, we're almost 10 years old now, but we've just gotten around in the last couple of years to being very specific about defining the role. What is it that we expect you to do? What are the attributes necessary for you to succeed? You know, it's just astounding that we didn't do that for a long time. We're just scrambling and everybody trying to get everything done, but I think we're getting a lot better about that. We promoted someone to be the director of human capital to give us that consistency with the culture, with the behavior, with the hiring process, with the job descriptions and the career path.
I also think it's important that you are always recruiting. Even if you don't have an open position, it's building that Rolodex, staying in touch with people, because you never know when a job opening comes up, when you're going to need to fill it.
Good point. One last question. Experience and skill versus credentialing, are they equally important?
And this is one of my favorites. Robert and I might disagree. I often say I don't care about where somebody went to college. You know, I happen to be someone who was a 4-year college athlete on scholarship to a college that I wouldn't have been able to get into had I not been an athlete. That is very important to me. That kind of, you know, if somebody has been a 4-year athlete anywhere, I'll interview them. That's, you know, but ultimately, you have to understand the business. You have to want to be there. Experience does help. You talked about operations. You know, we feel like we don't have many entry-level positions at Balentine because what we've figured is taking a lot of this experience from outside that you need to have in order to extrapolate the next situation is really important. So I like experience, but I more than anything else, I like grit.
Aaron, do we have time for one last question? Okay. For both Brittain and Robert, the future of private wealth management. This is a two-part question. How is Balentine preparing for the future of private wealth management? Or what is the future of private wealth management that Balentine is preparing for?
I don't think any of us have it figured out, so I try to spend a lot of time listening to what other people are doing and attending conferences, meeting with groups like this, and trying to figure out what I would want if I were that typical client. And I think at the end of the day, people are just trying to find somebody they can trust, they feel cares about them in an unconflicted environment. And I think the future of private wealth management is the business of advice. I want to hire somebody that can communicate because I can teach them investment management. Now, maybe that's because I have a BA in French and I don't have a CFA after my name or a PhD after my name. But if you don't have the ability to communicate what you do, I don't really care how smart you are. I think the better command we have of our subject matter, the simpler we're able to explain it. And so if you can take something really complicated and put it in a vernacular that the client understands, your future is very, very bright, because we live in an information society, but information is not knowledge and knowledge is not wisdom. And I think the future of private wealth management is to provide wise advice to a client, really caring about them and giving them access to information on their time frame. You know, being sure that your technology is up to speed so that at 11 o'clock on night when you're checking something online, it's updated and it's there. Or maybe the meeting with your advisor happens to be a digital meeting via Zoom and you're not in the same room. But I think the business of advice is going to continue, and it's not just money management advice. It's at what age should my kids inherit this money? What do I do about my daughter married to a high school football coach who wants distributions from the company when her husband, my son, or when her brother, my son, who's the CEO, wants to reinvest in order to expand the business? It's helping reconcile conflict. It's helping people lead purpose-driven lives and figuring out how they're going to take the money that they made and channel it to organizations that they care about to do good.
Questions from the audience?
You seem to imply, at least my interpretation of your comment, that growth through acquisition doesn't work very well. Eventually, people leave and clients leave. Is it your view that that is an extremely difficult way to grow successfully?
Yeah, I think these roll-ups are going to be really culturally challenged. I'm negative on big acquiring small. I'm not on kind of businesses of similar scale coming together if there is a common cultural alignment. It's better, in my opinion, to be able to grow organically, but we're always looking for advisors that fit our culture, that could be additive. If they've got revenue or a book of business they can bring, that's terrific. It's very hard, though, because you've got to find the cultural alignment, the compensation alignment, the investment philosophy and approach to money management alignment. It's hard to do. It's not impossible to do. And typically, once firms start getting north of 3 to 5 billion, the way they typically grow is through acquisition. But it requires a lot of homework. And it's just very hard to do, and I've not seen it be particularly successful when giant companies acquire small company, because small company people who love that collegial, collaborative environment where they can make their own decisions typically bristle under a more constrained, bureaucratic parent.
Just to expand on that, Robert, the practice of valuing your business, let's say annually, and thinking about who the next buyer might be, do all of these things kind of come together as far as managing a practice from the perspective of you're not reactive, you're engaged in that kind of process, if you find the right cultural fit between two organizations?
Well, that goes back to what I said earlier about always running your business as if it's for sale, because that gives you the most options.
Other questions? Tom? Yeah. Robert and Brittain, we thank you as far as